All right. Good morning, everyone. Again, this is JJ Arisha with Pismo Ventures, and Stephen has been accompanying me throughout the webinars. Thank you, Stephen. And we have with us today Amit Singh. And Amit is an attorney at Stradling Yaka, which is a prominent law firm here in Southern California. They do still have offices elsewhere in the country, but they are really big here in the Southland. Thank you all for being here. This is, I think, our 7th webinar. We still have up to 22 to go. So thank you for all being here and part of this. Today, I think the conversation is really important. It's about convertible notes versus safes. I'm sure you've all heard about all this, but I think Amit is going to break it down for us. So I'm going to give Amit the floor. I just want to give you an update on where we're at as far as the competition is concerned. We have started the scoring of round 1 for all the competitors. Like I've mentioned yesterday, the companies that emerge into round 2 will be announced on the 9th of October. So that would be by next week. All the investors, which we have about 120 of them, they are really hardworking at scoring and evaluating all the different applications. Just make sure that you're ready for 5-minute pitch and 5-minute Q&A for round 2, if you make it into round 2. And I hope you do. Good luck to everybody. Just like every webinar that we've had so far, we have a virtual networking time, a lounge after this. Stephen has already pasted or posted the link. If you have Chrome, you're doing your desktop, you can use Chrome, would be great. If you don't have Chrome, you can use your iPhone app or your Android app to be able to join. Please remember that there is a password that you need. We're trying to minimize the emails that everybody is receiving. So instead of sending everybody an email about that, you are to enter the password. And the password for today is Stradling-2020-VIP. That's it. If you have any questions, Amit has indicated that he's willing to answer questions interactively. Please put your questions into the Q&A section, not into the chat, because that way it's easier to segregate the Q&A from the rest of the chat. We will give you time at the end to also ask additional questions and also ask questions via live audio, if that's the case. Well, thank you very much for being here, Amit. Please just give us a brief introduction about yourself, and then the floor is yours.
Thanks, JJ. Yeah, thanks a lot for having me. So yeah, my name is Amit Singh. I'm a partner here at Stradling. For the last 20 years, I've been representing emerging growth companies and the investors that finance them or purchase them in venture capital transactions, private equity transactions, mergers and acquisitions, joint ventures, technology transactions like licensing transactions, and I act as that general counsel to those companies. But my target base is all transactions involving some kind of technology, whether it's medical device companies, software, SaaS companies, et cetera. They have some type of intellectual property. That's kind of the sweet spot for my expertise. So today I'll be talking about convertible notes and how they differ from safes and kind of the pros and cons of each. So let's get into it. So when you're looking at any type of venture type investment, I mean, these startups, these emerging growth companies, there's really 2 things you're looking at. One is reducing your downside risk in the event of a failed venture and capturing as much upside as possible in the event of success. Keeping in mind that the downside in investing in these companies is not like investing in a public company where maybe you lose 10, 25% of your money. The downside is most likely 100%. And in fact, the downside, losing 100%, is actually the more likely scenario in each of these investments. Let's be fair. So that's why, of course, venture type investments are expected. You have to invest, they say, 10 or 12 investments to be properly diversified in order to make up for all those losses, because hopefully you're going to have some that get 10x, 20x, 30x, that make up more than enough for all those losses. So I think sometimes people focus so much on the downside. I want a security interest on all the assets when the assets are likely zero, or maybe there are some assets, but in fact, those assets usually have little value without the management team. That's why the investors are always looking at, well, yeah, this has a great market, this has some great technology, but what is the team? Have these folks done this before, or do we think they're the right team? So those are kind of the overall considerations when choosing any kind of investment structure. And so the common investment structures you've probably all seen are preferred stock, convertible promissory notes, and more recently, safes. So why not just do preferred stock every time? First of all, you need shareholder consent. You're negotiating a multitude of documents. You file the charter with the Secretary of State. All this results in high transaction costs. It's time consuming. You got the lawyers arguing about things. And you do have standard terms like the National Venture Capital Association documents that we use a lot as corporate lawyers. But ultimately, it results in it being more time consuming. And in addition, one of the hardest things, and frankly, one of the most important things to negotiate, is the valuation. And negotiating that valuation is very difficult, especially early on. And maybe the angel investors and even the founders, maybe they're not so sophisticated early on and able to negotiate the valuation. And maybe the founders think the company's worth 5 million. The investors think the company's worth 2 or 3 million. And you just can't bridge that gap. So we instead use alternatives like convertible notes and safes. So convertible notes. I'll first talk about convertible notes and then talk about safes, because convertible notes originally were sort of the standard in this area. So what is a convertible note? It's a loan. So you're loaning money to the company, a certain principal amount that accrues interest, and it's due at a certain maturity date. And you hope before you get to that maturity date, it converts into stock, usually preferred stock. And there's 3 primary times when it would convert. One is the company gets sold before it otherwise converts. And usually you should have the option to get either your money back or some kind of return on that money, 2x or 3x or whatever your money, or the amount you'd receive if you'd converted to, let's say, common stock at some agreed valuation. So you're able to capture some upside here, but also have some downside protection. So at least you're getting some kind of return. The other time when it would convert is what we call a qualified financing. So the company raises additional money, presumably by a VC or some other sophisticated investor. And so you want to make sure that financing, and so you'll negotiate to convert into the same terms as that party, but at a discount. And so the presumption is that the next party is going to be smarter than us. They're going to be able to negotiate better terms than we could. They'll be able to figure out what the value is at the time that they make their investment. And so we're going to be relying on that party. So keep in mind, you want to make sure that investment is big enough to justify dictating all the terms of your investment, all the legal terms, all the business terms, including valuation. You want to make sure it's not, and you want to make sure it's on a sort of arm's length basis. And so you usually put some parameters around what that looks like. It would not be fair to raise $5 million in convertible notes and then have, let's say, the founder come in and put in 100 grand and dictate all the terms of that $5 million in investment. So we usually put parameters on it. It must be at least 1 or 2 times or 3 times the amount you raised in the notes. Or you just put a number on it and we know how much we're going to raise. Sometimes you also negotiate for an optional conversion at a maturity date. So it may be the case that, yeah, the company's gone sideways and it's nice to have that leverage to force the company to pay you back, which frankly, they're not going to have enough money anyway. So we often negotiate that you have the right to convert at some lower valuation that reflects the fact that things did go sideways. You didn't sell the company. You didn't raise the money you expected. So something's gone wrong. So you have the right to convert at some lower valuation that reflects those negative things. And because you still believe that there's some possibility of getting a multiplier on your investment if you were to stay in. And so you might want the option to convert rather than just get your money back in a 6% return. A big benefit of the convertible notes, at least a theoretical benefit, is you're deferring the valuation. So again, the VCs or whoever comes in next, they're going to determine the price of the next round. But let's say the next round is 2 years from now. It would not be fair for you to pay the same price as them, right? So you came in 2 years earlier when maybe there's no MVP. You couldn't tell if there was a market for this product. There have been no clinical trials. Whatever it is, there's lots of risk you took on early on that those investors who come in 6 months, 1 year, 2 years later aren't taking on. And so because of that, you get a discount to what they're paying. It's as low sometimes as 5%, as high as sometimes 60%. The average is probably about 20%. Often I like to, if I'm representing investors, negotiate that, well, okay, if you raise the money in 6 months, maybe it's 20%, 25%. But if you raise it in a year from now, maybe it should be more like 40%. Or if I allow you to go to 2 years, maybe it should be more like 60%. So that it properly compensates me for the risk I'm taking by coming in early. Also, one thing you worry about is you don't want, let's say, you're having that negotiation, is the company worth 3 million, 5 million? Okay, we go with a convertible note. We'll worry about it later. We kick the can down the road. You don't want them to take your money and go from what at most could have been a $5 million valuation to, let's say, in a great scenario, you're Zoom and you've got also the pandemic happened and things went wild, and now the valuation is 10, 20, 30, 50x what it originally was. So you negotiate a cap. You don't want them to go from, you convert it maybe even a 50% discount from a $100 million valuation when the company was worth at most 5 million when you invested. You're still missing out on the difference between 5 million and 50 million, $45 million in gain. You're not sharing in that at all. That's not fair. And so we negotiate a cap saying that, okay, no matter what, the maximum we think this company could be worth today is $5 million. So the maximum I'm going to convert at is $5 million. And so if the next round is at $100 million, I'm still converting at $5 million. And here's an example to kind of, and admittedly, this is an extreme example, but it's just meant to emphasize the importance of having a cap. So let's assume you get a 20% discount. You invest $100,000, and let's forget about whether or not anybody else invested. So let's just assume you're the only note investor. The Series A financing occurs at a $100 million valuation. So you converted a 20% discount, an $80 million valuation. So you end up with $100,000 divided by 80.1. So you get less, about 0.1% of the equity. So that's about $125,000 in value. So your $100,000 went up to $125,000. So you got a 25% increase in value when arguably the company's gone up in value by 20x, or well, clearly it's gone up by at least 20x. And so if you had a cap to protect yourself, you would end up with 100,000 divided by 5.1 million. So you end up with about 2% of that 100 million, so worth about $2 million. So now you've gotten a 20x theoretical return on that investment. You've shared in that increase in value. And we've also aligned the interest a little bit between the founders of the company and the investors. You wouldn't want, because you want to incentivize your investors to go out and make those connections for you to additional money, to additional customers, maybe other types of connections, or in some way be incentivized to help you and all be aligned. Without this cap, there's total misalignment because the investors don't want you to raise money at a high valuation. They want that conversion to occur first, and they get a discount, and then have all the growth occur later. So this helps align the incentives. So what are some of the issues with convertible notes? first of all, if you invest in preferred stock or common stock, any type of stock, the corporate code of wherever that company is incorporated has some baked in protections. The company and the board of directors and the management, they all owe you fiduciary duties. They can't negotiate for, the CEO can't sell a bunch of assets to the company at an unfair price, or do some other transaction with the company that is unfair. Or treat you somehow differently than other people who invested in the company. Here, there are no baked in protections. So unless you negotiate some kind of negative covenants, you have no protection. So for example, you don't want the company taking all the money you invest, let's say $5 million is invested in the company through convertible notes. You don't want them taking all that and dividending it to the company or to the company's shareholders. You want that money to go to operations, to running this company, growing the company. You don't want them exiting or getting any money until you're getting the same, and put in protections, get affiliate transactions, maybe limit the amount of debt that can be raised above you, etc. Sometimes, though rarely, you get a security interest in the asset. You get a lien in the assets, whether it's patents, equipment, etc. As I mentioned, with early stage companies, that the value of that may be relatively low, so negotiating for that probably isn't worth it. Really, usually it makes more sense at the later stages, unless there's some real IP or something else that could be monetized, and so you'd be first in line before any other creditors to go after those assets and squeeze the value out of them to at least repay you. When I'm representing the company, I worry about what we call the liquidation preference windfall. So if you convert at, let's say, 5 cents a share as a note holder, and the investors in the new round are paying $1 a share, if you get the exact same preferred stock shares that the investors are getting, then if the company goes under, your liquidation preference, the amount you get paid before the common stock, is based on $1 a share, even though you only paid 5 cents. So when everybody else is losing money, you're getting a 20x return. That's really unreasonable and unfair from a company perspective and founder perspective. So there's usually two ways, and also dividends are based on that price. So, let's say you pay a 5% dividend, it should be 5% on 5 cents to you, not 5% on $1 to you, because that would be an outsized return. So there's two ways we protect against that. One is we can use what we call shadow preferred. So the investors in the new round get Series A, the convertible note holders get A1 or something, a similar name. So it's the exact same terms, all the legal terms are all the same. The only difference is that the original issue price, which the dividends and liquidation preference all dovetail off of, is all based on the actual price paid, the 5 cents in my example. So you don't have that liquidation preference windfall. Sometimes if it turns out that it's, let's say the company's incorporated in California, or it's a Delaware corporation, but it's what we call a 2115 company. It's the majority of the shareholders or operations are in California. The California code, at least according to California, although Delaware disagrees and is probably right, California attempts to apply portions of its corporate code to the Delaware corporation. And part of that would include specific protections for various series of stock. In this case, the shadow preferred stock. So if the company is being sold, or they're somehow being treated differently in a transaction, that shadow preferred stock may have its own separate class vote. And so it could provide them leverage in a transaction that was never intended. And so what we do is we often issue them the exact same stock. So the Series A preferred stock that everybody else is receiving based on at the same price that everybody else is paying. And then any sort of discount shares they were supposed to receive, get those as common stock. And that way you don't have to worry about the liquidation preference windfall, and you also don't have to worry about that class vote issue. The caution is that you want to make sure that common stock going to those investors doesn't alter the control aspects of the common. You want to make sure that the founders still control the common after even the worst case scenario, the common stock issuance, no matter how dilutive it is. So maybe you control that by doing non-voting stock, but that has its own problems, or you have some kind of voting agreement that controls for that if that's a real risk. So it's something that I would think about, but that is a method I like, to come up with a formula to make it work. So tax, the capital gains holding period likely starts on the note issuance. So that's good. You typically don't have to worry that, okay, I invest now, I hold it for a year, and then I convert to common stock right before an acquisition, and oh, I get short-term capital gains treatment. Oh, I got screwed on taxes, even though I've been in this investment for a year. That's probably not a problem. You probably get capital gains. Your holding period for capital gains probably starts when you get your note. The stock received on conversion is eligible for qualified small business stock treatment usually, but the 5-year holding period likely does not start until you convert and receive the stock. So what is qualified small business stock? There's certain qualifications, but from a tax perspective, and the gist is that if your investment qualifies and you hold the stock for 5 years, then you can exclude up to 100% of the federal income tax gain, federal tax on the gain. And that's capped at 10 million, but that's an amazing benefit, and you would hate to lose out on that. And so keep in mind that if you invest via convertible note versus preferred stock, you may not get the benefit of that if the exit event, and it's a stock sale, occurs less than 5 years after your conversion. So now let's talk about safes. So safes were introduced by Y Combinator in 2013 as an alternative to convertible notes. In reality, we'd been doing the basic similar deals before Y Combinator sort of invented it, but they came up with their own form, and the intent was to reduce transaction costs. So this form agreement, and in the agreement, it even requires everybody to say, hey, I've not made any changes to this form. Much like notes, the transaction costs are lower, so there's no shareholder consent or a charter filing required. You're punting on valuation. All those same benefits from a transaction cost perspective are sort of multiplied because you have this one document that's a form document, and you're only intended to change the discount and the valuation, the post-money valuation cap on. So they become very popular on AngelList, and companies just seem to love it. Keep in mind that these statistics on AngelList skew the numbers quite a bit, because who is posting the document on AngelList? It's the company. So companies really like it. That doesn't necessarily represent that it's not that a majority of the deals are done via safes. It's just, if you look at AngelList, you would think that. But they are nonetheless very popular, and people are getting more and more comfortable with them. So they're very similar to convertible notes. So like a convertible note, you're giving money to the company and you're expecting it to convert on certain terms into a certain class of stock. The main difference is that there's no maturity date and no interest rate. So from a company's perspective, that's great. You're not worrying about, and frankly, investors don't care that much about getting a 6% interest rate. That's, who really cares? That's not much. You're taking on massive risk and you expect a massive return or lose all your money. But that maturity date has a ton of value for the investor, because you don't want the people running the company to be making a couple $100,000 a year, having a great time, but not seeking an exit for you, and not bringing in additional smart money. You want to keep this thing growing. You don't want it just going sideways and have a lifestyle company. And in addition, if something goes wrong, at least you know that you'll have, even if there's no money, you'll have some leverage over the company if that maturity date comes. You'll be able to negotiate maybe for a conversion or something else, or maybe repayment at a discount, something. But gives you a seat at the table, some protection. Here, you're just going to go sideways. There's no way to force anything to happen. So here, this converts, much like the convertible note, it converts at a discount to the next round. Let's say, for like in my example before, 20%. But in the convertible note, the valuation cap is calculated on a pre-money basis. So if I invest $1 million and the company raises no additional money, I'm going to get 1/5 plus my $1 million, 1/6. However, the company raises a total of $5 million, I'm going to get, before the next round comes in, 1/5 plus 5, so 1/10. I'm going to get 10% of the company before, or actually, I guess, actually 11, 1/11. So, the amount I get, it's unclear to me in a convertible note what percentage of the company I'm going to have before the next round. In a safe, it's very clear. You're going to, if it's a post-money safe, I'm going to get, and the post-money valuation is 6 million. No matter how much money is raised in safes, I'm going to get 1/6 of the company before the next money comes in. So that's really nice to know as an investor. But we'll talk about that a little bit more later on, because there's some real risks with that from a company perspective. It also converts on a liquidity event. You receive the greater of the amount you invested or the amount you would have received if you did converted to common stock. Keep in mind from a company perspective that based on the plain language of the safe, that amount is paid at the closing of the exit transaction, the sale transaction. So if there's some money is escrowed, or there's a holdback, or there's part of the money earned, a large chunk of the money earned is through an earnout, it may be the case that the safes receive whatever percent of the deal, the overall deal value they're supposed to receive all at once without regard to those risks that money is actually never paid. So that's something that I'd really be careful of with using the safe if I'm a company. So some differences with convertible notes. So there's no minimum deal size. There's no sort of idea of this qualified financing that has to be a certain deal size to force conversion. So I could invest $5 million in convertible notes, and the next round is $100,000, and that $100,000 investment by the founder, by the way, is dictating all the terms of my $5 million investment. That's the tail wagging the dog. That's ripe for problems. So that worries me. There's also no events of default where I could get paid earlier. In a convertible note, there's typically things like if the representations and warranties were untrue, you get a forced repayment. If the company, breaches obligations to other creditors, you accelerate the debt, things like that. And here, this is paid after debt. This is not debt. This is intended to be on par with preferred stock. So this is meant to be like a preferred stock investment. There's no liquidation preference windfall because there's shadow preferred. They use shadow preferred to deal with that issue. And then, so let's talk a little bit about that post-money valuation cap. So as I mentioned, you're not diluted by additional safes or other securities being issued. At the closing of the next round, right before that round, the safe will represent an agreed percentage of the pre-money capitalization of the company. And you exclude the option pool increase in that calculation. So like I mentioned, if I invest $1 million in a safe with a post-money valuation cap of 5 million, my safe will represent 20% of the pre-money cap table before the next round, even if $2 million is raised. Now keep this in mind, that this is ripe for mistakes, and I've seen mistakes happen here. So in an extreme example, if you sold $5 million in safes with a post-money valuation cap of $5 million, then the safes would represent 100% of the pre-money cap table of the company before the next round. So the founders of the company would literally have 0 of the company. And I've not seen that extreme of example happen. However, I have inherited a client from another firm where they issued a bunch of safes with a post-money cap. And the founders thought that it was $1 million raised at a $5 million pre-money, and they issued a couple $1 million worth of safes. So, but much to their chagrin, they found out that they didn't have 1/7. The safe holders didn't have 1/7 in the company. They instead had 1/5 in the company. Luckily, those investors were very close to the founders, and we were able to negotiate with them to get them to the point where everybody actually thought they were supposed to be in the first place. But not everybody would be quite so nice. So there's some nice protections baked into the safe. One is that the dividends are paid pro rata. So if the company takes your money and dividends it out, you get your pro rata percentage of that. Of course, that's not great, but it's some protection. My preference is to actually have a block on dividends. There should be no dividends paid. Nobody should be getting any money until the actual exit, but it's some protection. And you can also, there's a separate side letter you can get that's on the Y Combinator site. And basically what it says that if your safe is supposed to be represent 20% of the company before the next round comes in, it allows you to purchase 20% of the new round so that after the new round closes, you own 20% of the company. And it's not at a discount or anything like that, but you just can purchase it at the same terms as the new investors. And that way you can make sure that you have the right to maintain your pro rata ownership in that company. So how are safes treated? So first of all, it's not 100% clear, but we become more and more comfortable that it's most likely treated as an equity investment. And as a result, the capital gains holding period and that the 1 year capital gains holding period and that 5-year qualified small business stock holding period likely both start at the issue date when you receive that instrument, which is nice. That's actually the qualified small business stock holding period treatment. That actually is a benefit over the convertible notes. So what are some additional concerns? So first of all, safes and often convertible notes have limited representations and warranties. I typically want detailed representations and warranties. First, if they're untrue, it gets you a right to sue the company and get your money back, but that's less the benefit. More of the benefit is that it helps you in your due diligence of the company. You're basically having the company say, these things are true. And they will spend time making sure that those things are true and tell you to the extent those are not true. So it makes you feel more comfortable that you have the information you need in order to make this investment decision. In the safe, it's very limited, and oftentimes in convertible notes, it's limited. I typically like detailed representations and warranties. They both typically don't provide you with any board representation or even observer rights. Again, with a convertible note, you can negotiate that. Safes just have no provision for that. Both of them have no fiduciary duties owed, and there's no protective provisions, nothing to block. You can't block the company from doing anything. There's no right to information, so you can't get financial statements or anything like that. If you're a stockholder, you automatically get those information rights. You get to see the books and records of the company. And in safes, there's no minimum deal size for conversion. So I try to negotiate for a side letter, since we maybe agree, okay, we're not going to modify the safe document, so it's easy for everybody to understand, but we negotiate a simple side letter that provides all these things. Hey, we get an observer if we're not on the board. You'll owe the same fiduciary duties to us as you would owe to us if we owned the number of shares of common stock that this note or safe would convert into. You can't do these things without our consent. We're going to get access to the same information we'd have access to if we were a stockholder. And in fact, we'll also get financial statements quarterly, et cetera. And despite what it says in the safe, the next financing round will not force the conversion of the safe unless I agree otherwise, unless it meets these specific parameters, including being a specific deal size, 2 times the amount of raised under the safes. So in summary, safes and convertible notes are great instruments for an investment, potentially, because they are very efficient. You can do them very quickly. The legal fees are typically lower, and gets the company its money very quickly. But you have to be very careful and do them right. One of the disadvantages from a company perspective of safes is, again, that the cap is calculated on a post-money basis. So you have to be very careful, especially if you aren't sure how much money you're raising. You have to make sure that each time you raise additional funds, you're increasing that post-money cap. Otherwise, you could be giving away much more of the company than you thought you were. There's no maturity date, so there's no sort of time frame where you can say, look at guys, now I've been in this investment for a long time. You either got to pay me back or give me something, or let's agree on a plan going forward, and then maybe I'll extend the maturity date. There's no interest rate, but who cares about that? There's no minimum deal size for conversion, so we should be careful of that. So in general, I would say that they're likely as good as notes on the upside, much worse on the downside. But as I mentioned, downside is probably, in most cases, 100%, even if you had a secured promissory note. So if you're only really focused on the upside, you should at least make sure that there's a minimum deal size for the next round so that it is a real round that's dictating your ultimate terms by somebody sophisticated. And all that can be done via a side letter. And my contact information is there. I'm happy to field any questions now.
So Amit, we have a few questions from Deepu. The first is, what are your thoughts on the WeFunder Safe?
WeFunder Safe, I would say, is something that I've not used extensively, so I probably can't comment extensively on that document, frankly.
And if you want to read them, you can read them yourself if you click on Q&A instead of. The first one is, what do you consider sophisticated investor?
Well, that's a good question. Well, first of all, what we focus on from a securities law perspective, initially at the minimum, is everybody needs to be accredited, meaning that you're at least basically a millionaire, or you earn a couple $100,000 or a year if you're single, or 200,000, 300,000 if you're married. So that's a basic thing. But then you also do want your investors to be sophisticated. So maybe they have some experience investing in these types of ventures. You usually have them sign some kind of representation letter saying that they have all this experience. But the reality is a lot of times you're taking money from unsophisticated investors. So it's ultimately in the eye of the beholder. You, as a company, want to be careful not taking money from people who just don't understand it. Don't understand that they could lose all their money, and they have the wherewithal to actually take on that loss. But also, you don't want them to be some squeaky wheel. They put $25,000 into your company. They're calling you all the time, hassling you, and not allowing you to run your business. That's probably one of the most important things I look for.
Where's my money, right?
Yeah, exactly. And actually, I have a client right now. We're raising $5 million. Most people are putting in a minimum of $300,000. One guy, he's asking to put in $25,000, and he has all these requirements. I want all these blocking rights and all these things. I want observation rights. It's like, seriously, look at how much you're investing.
Yeah, exactly.
I told my client, do not take this guy's money. Even if you don't give him any of that, do not take his money.
Absolutely not. Yes. Can you see the Q&A, Amit?
Oh yeah. Let's see.
You can click on that.
Let's see. Why mess with notes or preferred stock? Why not issue common stock? So common stock, that's actually a good question. So if you issue, first of all, if I'm an investor and I put in $1 million in your company for, let's say, 10% of the company, if the company were to be liquidated right away because things go south, or maybe the company is sold at a low valuation, I don't want to get 10% of my money, right? I want to get at least my money back. I expect to get at least my money back before you get anything. You should not be, as the founders, you should not be getting any money back, especially not anything from my money, until I've gotten a return on my investment. And secondly, if you issue common stock, let's say at $1 to everybody, you can't issue your options with an exercise price at lower than that amount. And so you're reducing the incentive to your employees, because you want your employees to be able to capture as much upside as possible. And it would be difficult to argue that the employees' common stock is worth less than the common stock paid for by the investors, because it's the exact same thing. So preferred stock has various rights like liquidation preferences that make sure that the investors get paid first. It also separates the value of the amount, the price per share paid by the investors versus the amount paid by the employees for tax purposes. So there's lots of reasons. And then of course, convertible notes, you have some benefits because you've got a maturity date. So if things are going sideways, you have the benefit of being able to say, hey guys, let's talk about this. What are we going to do to make sure I'm getting a return? And also full ratchet, right? You're making sure that you're going to have a certain percentage in the company. Most preferred stock rounds are weighted, have what's called weighted average anti-dilution. So you're going to, when you issue additional stock, if it's not at a lower price, there's not going to be any change in your price. If they issue at a lower price, you're going to get adjusted to some extent. Protection. You're also getting just percentage ownership protection until that conversion occurs. So there's a lot of benefits in being a safe or convertible note, frankly, at the early stage. And again, you're negotiating for value a lot less, and so you can kind of kick the can down the road. And then let's see. Oh, what's a typical time frame to set up safes versus notes? I would say that they're probably similar. Notes would be longer just because it's not always the same form. And this also presumes you're going with the Y Combinator safe. I've got my own version of a safe. Many other lawyers have their own version of a safe. But when we're talking about a safe, typically we're talking about the Y Combinator version. And if you just go with that and don't negotiate side letters or anything, it can be very fast and very efficient. Maybe a few grand from the company perspective, except for the diligence that's required. That's where it's sort of the same with any investment. Your legal team will want to look at the company. So you're reducing the negotiation on the documents, but not necessarily the diligence that's going into the company. Let's see. So I think we talked about the tax benefits. I think that question was answered. Could one write off a bad debt if the company were not to be successful? So that's probably, I guess, I don't necessarily, I'd probably want to talk to my tax partner because it ultimately depends on the terms of the document. And of course, you can write it off as a loss, but the question is it an ordinary loss or a capital loss? You can clearly write it off, but it depends on the tax treatment. And that ultimately depends on the language. Does it look more like stock, or is it looking more like debt? And then let's see. When talking about the pros and cons, are you talking from the company point of view or investor point of view? And I would say I'm talking sort of both, right? So they both have pros and cons for each side. So from a company perspective, the safe is great because there's no maturity date, no interest rate, but then it's calculated on a post-money basis. So if I raise additional funds, I'm not diluting that. I'm only diluting myself. So every time I additional funds, I'm only diluting myself. So I have to make sure I'm increasing that post-money valuation each time for at least the new people. If from an investor standpoint, I like the safe from the perspective that I know what percentage I'm going to get before the next round, which is very nice. But I have no ability to force a sort of lifestyle company to do anything. The founders aren't forced to convert me. There's not forced to raise additional funds, not forced to sell the company. So I could be going sideways theoretically forever. And there's very few representations and warranties. There's virtually no downside protection. But the upside is pretty good. But again, I would want to make sure that the round that's going to dictate my terms is of a minimum size, and that's not baked into the safe. I think that's all the questions that were posted.
All the questions, yeah, exactly. So if anyone has additional questions, please put them in the Q&A right now. Or if you'd like to ask a question via live audio, please just raise your hand and I'll bring you in. Amit, you could stop sharing if you want.
Okay, let's see.
Anyone with a live question? Any more questions that you can put in the Q&A? So we have a comment. Amit says, this is really great information, very useful and well explained.
Oh, thank you. I appreciate that.
No, you did. I mean, you broke it down quite a bit. I mean, it's, of course, there's a lot more. This is not it. So,
and that's why we have lawyers, right? I'd be out of a job if I could just post a PowerPoint and then it sort of explains the world.
it's
So
all
ultimately,
done, right? Yeah.
Sophisticated counsel to represent you either as the company or the investor to really understand this particular deal, given the specific circumstances of this company and the investment you're making.
So, you know, I learned something new from you today. I mean, I've been doing this for a long time. I've seen so many of those, but like, you know, the side letter, you talked about having a side letter in addition, which I think is really good to have, you know, when you're doing, regardless of safe or a convertible note, either one, right? So that's good to have.
With a convertible note, you can kind of bake everything you would have put into a side letter for the safe, just right into convertible note terms, because there is no sort of basic agreed term form for that. So you wouldn't necessarily have to have a side letter, but the safe, clearly, the idea is you're not meant to modify it. So any modification should be by a separate document.
Right, exactly. So that you could certify it hasn't been modified.
Yeah, exactly. Except that we're agreeing to something else.
Yeah, exactly.
And again, there's reasons why both the company and the investors would agree to a side letter, because there are positives and negatives for the safe on both ends. So you can come to a more reasonable compromise that gets you to where everybody thinks we should be.
Yep, we have another question from Ong. If you can, instead of reading it, maybe you can look at it.
Oh, let's see. Let's see, it's easy for me to read it at the same time. If you offered safe or convertible for a startup in a seed round, would you have freedom to change it in the next round? Is it better to put silent partner clause as well as protecting majority rights for founder? In the case of Mark Zuckerberg. So let's see. So if you offered a safe or convertible note for a startup in a seed round, should you have freedom to change it in the next round? I guess the idea is that you're agreed to a contract. So as to that existing investor that invests in that, without their consent, you should not be able to change it. But there's no reason why you can't raise money on different terms with other folks in the future, keeping in mind that the safe, for example, is not going to be diluted by that additional money. And the safe, and often the convertible notes, we have a provision when we're representing the investors that says, it's called a most favored nations clause. It says that if you give better terms to somebody else, I get those terms.
Yep.
So I get the benefit of that. So keep that in mind when giving additional terms to somebody else. You have to think about, how does that affect the other instruments I've issued so far? And in fact, do I need consent of them to issue those?
That's really good, actually.
And then the question is it better to put silent partner clause as well as protecting majority voting rights for founder? I guess maybe what that refers to is that you're going to get on conversion non-voting stock. And of course that'd be great from a company perspective. And you know, often when I'm representing entrepreneurs, they want to get, they think they're Mark Zuckerberg and they think they're going to get Class B common stock that's got a 10x vote over the regular common stock, the Class A common stock. But usually when the sophisticated VCs come in, unless this is the hottest deal in town, they're going to say, no, you've got to get rid of that. I'm not agreeing to that. We're in this together. I'm agreeing to get a certain percentage of the company. I get board representation related to that, all that. So you can try to get that. And maybe if you got unsophisticated investors, you're more likely to get that. But ultimately, only the hottest deals end up maintaining those protections.
Yep, that's very, very good. Another thing that I learned from you, I have to say today, is I heard it before, but you reminded me that we got to really think more about that, and that is the discount. When you're talking about the discount, and the discount is if you raise money in the next 6 months to a year, 20% is good. But 3 years from now, I need 60.
Exactly.
It makes a lot of sense. And again, we've been seeing 20 and we stick to 20 and they go raise money 2 years later and it's still at 20. Doesn't make sense.
Yeah, the amount of risk you took on 2 years earlier is exponential over somebody who came in 2 years later. They've got clinical trial results, they've got an MVP, sales, whatever it is, some milestones to cause that larger round to come in.
Yeah, that definitely clicked with me because it's happened before. I mean, one time there was a company that 5 years later, they raised money and it's still at 20%.
Oh, wow. That is terrible.
And that's what it is. It was there and it's there.
Yeah.
So
Yeah.
that is terrible. So
Yeah.
what's kind of, what have you seen when it comes to that? What kind of a discount and the length of time? What have you seen there?
So obviously it just runs the gamut.
Yeah.
When I represent a company, most times investors don't even ask for it. But if I'm on the investor side, I sometimes will agree, okay, yeah, if you raise it in 3 months, 5%, still have the cap that we negotiate.
Right, exactly.
Yeah, 5%, because our risk is similar. And you could even argue it's a similar, almost like the same round.
Right.
6 months, maybe it's 20%. We're talking a year, maybe 30%. When we get to 2 years, 50%, maybe 60%.
Wow, that much. Okay.
Yeah.
That's quite interesting. Okay.
Yeah.
That's good to know.
All right. Time value money and massive amounts of risk. Obviously, take a Black-Scholes to that, it's going to, be a big difference.
Yeah. Yeah. Okay, everyone, it seems like there are no more. Oh, there's two more questions that just came through from Anthony. So Anthony says, one more quick question. How does a safe work on the cap table? Is it similar to convertible note?
Yeah, it's very similar to a convertible note. I usually calculate it based on, before the next round, you have to base it on the cap. But you usually have in your cap table, it's dynamic. So you're able to say, put in certain assumptions. Okay, well, the next round is at raising X dollars at X valuation, what does this represent? So you're able to play with it on a pro forma basis, but just on the assumptions, you usually put it in just at the cap because that's all you have. But ultimately, it could be more dilutive than that. You just don't know what the next round looks like.
I don't know if you mentioned this or not, but the one major difference between a convertible note and a cap is the convertible note. I'm sorry, the safe and a convertible note is that the safe does not go on your balance sheet.
Yeah, that's a good point.
So it's not considered a debt, and that's why most companies like it, because it doesn't go on their balance sheet. So. But the convertible note does, because it is a note.
Yeah, exactly. Hopefully temporarily, and it comes off the balance sheet. Right. And then also keep in mind that if you're a convertible note holder and you agree to convert your interest, you are going to be taxed on that interest. And that's what results in what we call phantom income. So you're taxed on in money that you actually aren't receiving because it's just becoming stock. Usually, since the interest rate is low, it's a small issue. But if I'm an investor, I sometimes like the option of getting paid out in cash for that small amount, just so that I'm not out of pocket on something that may be worth nothing in the long run.
Or you want a little bit more interest, so you get more shares, more equity when it converts, exactly. Right? Although it's still phantom, but yes. All right, we got some more questions. Brian, you see that?
Oh, yeah. So Brian's asking if I discussed the KISS and the differences, and I didn't. and it's frankly because the KISS seemed like it was going to be something, but it's you really just don't see it anymore. Nobody's using the KISS anymore. You see either, convertible notes, the Y Combinator safe, or a safe sort of invented by your lawyer or the company's lawyer, like myself. I have my own version of the safe that has a pre-money valuation so that we can raise additional money, and has some other bells and whistles. It sort of bridges the gap, has a lot of the things, both from the company side and the investor side, that gets us to what I think is a more reasonable middle ground that fixes what I view as the problems with the safe.
Yep. Okay. All right.
Then, oh yeah, Mohan asked your balance sheet question. Oh, okay. So if it's not on the balance sheet, where is it accounted for in the financial statement? So it's the same as stock, right? So it appears the same as a stock on your balance sheet. The paid in capital. Okay. No problem, Anthony. This doesn't have to be your last question. How does IRS Rule 83B come into play to avoid the fan income? Is this out of scope? So 83B actually doesn't apply. So 83B, I'm happy to answer the question, but it relates to 83A, which is if you're, let's say, an employee of the company and you get stock, or the founder of the company, you get stock subject to vesting, as all things being, without doing anything, as the stock vests, you get taxed on the difference between the fair market value of the stock and the exercise price of that stock, or the price you paid for that stock. Or sorry, it doesn't apply to options, but the price you paid for that stock. So if you paid 10 cents a share and then 1 million shares vest after a year, and the shares are worth $1, you're going to get taxed on that spread. To avoid that result, you file an 83B election within 30 days of receiving that stock, and it says to the IRS, hey, I understand these shares are subject to substantial risk of forfeiture, which is sort of the IRS provision, but the phrase, but the meaning is that I understand I may not get to keep all this stock. Nonetheless, I'm going to agree today on the date, the date I got this stock, I'm going to pay the tax on the difference between what I pay and the fair market value of that stock now. And if I do, then as that stock vests, there's no tax. So there's no tax effect. And so if you believe the stock is to go up in value, you do that. And usually you're paying the fair market value of the stock in the first place on the date you purchase it. So that difference should be zero. So most of the time, 99% of the time, there's no reason not to, and it's a major screw up if you don't. So happy to answer that question.
All right, very good. All right, if there are no more questions, any live questions, raise your hands. The last chance. Any more questions? Last chance. All right, we're gonna go into the virtual networking lounge. Hopefully, Amit, you can go there for a few minutes, if you don't mind.
Happy to.
That way you can, potentially answer some questions, mingle with the entrepreneurs as well. So the link is in the chat. Please grab it now, copy it somewhere. And there is a password as well. So please copy the link and the password. When you can use it on your iPhone app or Android app, or you can use it on desktop. Use Chrome if you're on your desktop to make it easier for you to join. If there is no table available, so when you go in, Amit, you will go directly into VIP tables. If there's no table available, you can click on a plus sign and create your own table, and people join you. So, or you can join an existing table. That's kind of how the virtual networking works. So.
Okay, that sounds great. And my contact information is a PowerPoint, which JJ can send to everybody. Yeah, and feel free to reach out if anybody has any questions or if I can help in any way. Thanks, everybody. Look forward to the lounge.
Amit, thank you so much. This has been really awesome. We appreciate it.
Cheers, guys.
Talk soon. Bye-bye. All right. See you there.